Welcome to this explainer. Grab your cleats, folks, because today we are stepping right onto the field to break down the absolute latest round of Q2 earnings in the fintech sector. You can really think of this current market like the NFL's August roster cut season. Wall Street is out there ruthlessly evaluating these companies right now. It is a super high-stakes environment. And, well, spoiler alert, not everybody is making the team. So here's our playbook for today. First, we'll look at the fintech roster cuts in general. Then we dive into Upstart, our comeback kid, followed by FIS benching its forecast. After that, we'll check out Toast, the unstoppable franchise, and finally, wrap it all up with our post-game takeaway. All right, let's kick things off with Section 1, the fintech roster cuts, setting the macro scene. So just like NFL teams trimming the fat before week 1 to get down to that magic number of 53 players, the market environment right now is brutal. It's demanding profitability, crystal clear guidance, and absolutely no excuses. Wall Street essentially runs its own version of a training camp every August during earnings season, and this brilliantly illustrates the stakes for these fintech companies today. It gives us a really perfect lens to view our three subjects. We've got one spectacular comeback, one stumbling veteran, and one totally unstoppable franchise. Moving right along to Section 2, Upstart, the comeback kid returning to the black. Okay, let's talk about Upstart because they just had the kind of quarter that completely erases 2 solid years of the whole "is this thing dead" discourse. I mean, the box score here is wild. Revenue jumped 42% year over year to $365 million. Net income actually more than doubled, and loan originations shot up 50%. Because of all this, their shares surged over 15%. They returned to true, undeniable GAAP profitability, meaning, their core business is actually making real money according to standard accounting rules. And as co-founder and CEO Paul Gu plainly framed it, they pulled off this massive growth without needing to issue any new equity, all while confidently reiterating their $1.4 billion full-year revenue guidance. But if you take anything away from this, it's this crucial number right here, $193 million in contribution profit. That is an all-time high for them. So why does this matter so much? Well, because it's literally the absolute cleanest read on whether Upstart's core thesis, which is their AI underwriting, actually makes money on each loan it touches before all that corporate overhead kicks in. And this number, it proves that it absolutely does. It's honestly the equivalent of a team that got benched for 2 seasons and comes back throwing 40-yard touchdowns in the fourth quarter. Nobody was fading Upstart on the way up, but a lot of folks had quietly just stopped watching them over the last couple of years. Well, not anymore. Upstart didn't just beat the quarter. They thoroughly beat the narrative that AI lending was just some fleeting 2021 fad. They are back on the field, and they are throwing deep. Which brings us to Section 3, FIS benches its forecast, the stumbling veteran. So this is a fascinating contrast because FIS actually won the box score, but man, they lost the crowd. Look, they technically beat the street estimate with adjusted EPS at $1.48, and revenue did grow 29%, but that was largely thanks to a massive acquisition they closed earlier this year. The thing is, beating the current quarter means absolutely nothing if you're going to cut next year's forecast in the exact same breath. And that's what happened. The headline that actually moved the stock was their lowered full-year EPS and trimmed revenue guidance, bringing it down to the $13.6 billion range. So what exactly went wrong here? Well, the main culprit was soft capital markets growth, combined with slower sales cycles and delayed implementations that just ended up pushing revenue into future quarters. Now, CEO Stephanie Ferris did point to continued bank investments in tech modernization in AI as a bright spot. But to be frank, investors simply weren't buying the excuse, and that sent shares sliding right on the news. To give you some context, FIS has spent the past 2 years executing some major roster surgery of its own. They spun off their stake in WorldPay, then immediately turned around and paid an eye-watering $13.47 billion for global payments issuer solutions business earlier this year. So today's guidance cut, it's a really harsh reminder for investors that integrating massive M&A deals, literally smashing 2 giant corporate cultures and tech stacks together, that doesn't happen on a straight line. It is a super bumpy road, and right now FIS is definitely feeling the turbulence. All right, on to Section 4, Toast, the unstoppable franchise, ignoring the slowdown. Now, while everyone else in fintech seems to be managing macro headwinds, Toast just keeps grilling. I mean, look at these unstoppable stats. Gross payment volume rose 22% to a staggering $60.7 billion. Subscription and FinTech gross profit jumped 31%. Diluted EPS hit 26 cents, up from 13 cents last year, and they added roughly 9,500 net new restaurant locations. That pushes their total base up 22% year over year. And on the back of these massive numbers, they just effortlessly raised their full-year guidance. The crazy thing is, Toast has quietly become the default operating system for restaurants, from your little neighborhood diners all the way to Applebee's. Think about it. In a summer where flashy, fleeting food trends dominate TikTok, actual, real-world restaurants are running their kitchens, their payroll, and their payments directly through Toast's platform. It just proves that the boring, back-end business is where the real money is made. It perfectly brings up this point. Toast isn't just surviving the restaurant industry's margin squeeze, it's the reason a lot of restaurants are surviving it too. They aren't just some vendor providing nice-to-have software anymore. As margins get squeezed from absolutely every direction, Toast has become a complete necessity for these businesses to stay afloat. Finally, let's head into Section 5, the post-game takeaway, the final score. So, looking at our final scoreboard here, the narrative is crystal clear. Upstart, they totally earned their way back to the black, proving that their AI model can generate real, tangible profit. FIS technically beat the quarter, but effectively benched its own future amidst all those messy integrations. And Toast, well, they operated like a dynasty that just keeps drafting well year after year, completely ignoring any supposed August slowdown. So as you digest this explainer, I want to leave you with this. Will your portfolio make the 53-man roster, or are you holding on to players who just benched their own year? Seriously, ask yourself how your own investments stack up in this ruthless environment. Wall Street is making its cuts right now, so you need to make sure your portfolio is ready for week 1. Thanks so much for joining me today, and hey, don't forget to check our sources for deeper daily coverage on the entire fintech space. Catch you next time.